Let's talk investing. If you've been waiting for the perfect time to start, you're not alone. A lot of people hesitate because they're afraid of making mistakes, worried about a market crash, or just unsure where to begin. But here's the truth, waiting is usually the biggest mistake. So today I'll walk you through how to start investing as a beginner, why you shouldn't be timing the market, and how investing in a recession can be used to your advantage. By the end of this video, you'll have a clear, simple strategy to get started. No guesswork, no day trading nonsense, just smart, long-term investing that can help build wealth over time. Now, before we dive into how to invest, let's talk about the why. Investing is all about making your money work for you. If you're just saving cash in a bank, inflation is eating away at it. Historically, the stock market has averaged around a 10% annual return, which is far better than a savings account giving you 0.5% or even a high-yield savings account at 4%. But the real magic happens once you start investing early, even with small amounts. Let's run the numbers. Scenario 1. If you invest $100 a month at an 8% return starting at 25, by retirement age, which is around 65, you'll have $349,000. Scenario 2. You wait until you're age 35 to start investing the same amount. Now you only have $146,000, less than half. Scenario 3. If you invest $300 per month starting at 25, by 65 that grows to over $1 million. With the power of compound interest, your money is growing exponentially over time. So the key takeaway, start investing now, even if it's just a little bit. Now that we understand why investing is so important, let's talk about how we actually can do it. If you're a beginner, the best way to start investing is in something simple, diversified, and low cost. That's where index funds come in. Index funds are essentially a basket of stocks that track a particular market index like the S&P 500. Instead of picking individual stocks, which is risky, you're investing in 500 of the biggest US companies all at once. Historically, the S&P 500 has averaged a return of about 10% each year, and it requires zero effort to track on your end. Just invest and hold. Some examples of S&P 500 ETFs are Vanguard S&P 500 ETF, SPDR S&P 500 ETF, Fidelity's Zero Large Cap Index, and Charles Schwab S&P ETF. Now, where should you hold all of these investments? Here's two options. Option 1, Roth IRA. You invest post-tax money, but it grows tax-free forever. This is a no-brainer if you qualify. Option 2, 401k. If your job offers one and there's an employer match, take it. That's free money. Both of these allow your money to grow tax-free, which means you get to keep more of your gains over time. Now let's talk about where to invest. 3 of the best brokers for beginners are Vanguard, Fidelity, and Charles Schwab. Each have their pros and cons, so let's compare now. If you want low-cost, long-term investing, Vanguard is great. If you prefer an easy-to-use app with fractional shares, which is investing as little as $1, Fidelity is best. But if you want great customer service and a full-service bank, Schwab is a solid choice. Now let's talk about investing in a recession and why it's actually a good idea. A lot of people panic when the stock market drops, but if you're a long-term investor, it's actually something you can use to your opportunity. When stocks are on sale during a downturn, you can buy more shares for the same price. Historically, every major downturn has been followed by a recovery. So if you're investing consistently, downturns are your best friend because you're getting in at a lower price. Let's look at an example. If you buy one share of an index fund at $400 and the market drops 20%, now it's $320. Buying at a lower price means higher gains when the market recovers. The key is to not panic sell. Keep investing consistently and you'll come ahead when the market bounces back. Okay, so let's break down everything we talked about into 3 simple steps to get you started investing today. Option 1, pick a brokerage. Vanguard, Fidelity, Charles Schwab, you can sign up online in minutes. Option 2, choose your investments. I would say you start off with an S&P 500 fund like the VU or FXAIX. 3, set up auto investing. Even investing as little as $50 each month will do something for you in the long term. But the more you can do, the better, because that will grow into serious money. That's it. No complicated stock picking, no timing the market, just a proven stress-free way to start building wealth. If you found this video helpful, make sure you like and subscribe. It keeps you in the loop for future videos and helps the channel out. And if you have any questions, drop in the comments. Somebody like me or somebody else watching this video could be able to help you out. Now, go start investing. Your future self will thank you.